Well, howdy, y'all. This is Market Explainer, episode 48. We are America's number one business news podcast. I, of course, am always Danny and joined by my co-host.
That's right. Taste it.
The big
taste
man.
It.
Yeah, I'm going to jump into this next story because this was a fun one. I want to tell you about my company, Powerhouse Drones. Drones are becoming more and more ubiquitous. If you want to learn about just basic information about drones and you want to collect a little bit of information on making a purchasing decision, you should go to powerhousedrones.com. That is the sponsor for this segment, where we're going to talk about how Lime Scooters has raised over $500 million, and they plan on taking their scooter company public.
Okay, Danny, I guess Danny just goes to Google or, in Danny's case, DuckDuckGo, and types in dumb stories that, are worth $500 billion, or dumb stories that business ideas that should never happen, right?
Listen, you can stop at dumb stories.
Okay, so because you have a scooter company called Lime. Okay, scooter companies in general. Okay, we just talked about a company, Zillow, that gets to a point where, they're losing money, so they're going to cut off their arm so that they can survive a company. Right. Now you have an example of the arm itself. That's what this is. Lime is the arm that's dying, that no one wants to cut off for whatever reason. These scooter companies, electric scooter companies in all these urban areas or whatever, there's several of them. Lime is one of the bigger ones, right?
Yes.
That continues to garner money. And oh, by the way, if you look, it failed to get certain loans last year, right? Because it obviously got hit with Dos Equis and everything else.
Nobody's going anywhere.
Nobody was renting scooters of any kind, right? Riding or sanding or any of the other scooter models. But so it failed to get certain loans and tried to go SPAC last year and failed.
Right.
Because of, again, you shouldn't be a publicly traded company. Now, the problem with this is they have yet, in any way, fashion, or form, and again, we get into wording of articles, right? Wording of articles. Where the wording of this article is they've finally had their first quarter where they showed a gross profit, right? Meaning that they haven't shown a profit at all.
Right. Still lost money.
They lost money, but not of this money. Not entirely. Not of this money. Because, look, all of these... think about all the scooter manufacturers out there, whether it's a scooter like you ride on that looks like a motorcycle, or a scooter like the electric scooters that everybody rides around standing up. Yeah. This company offers a variety of different scooter options.
I didn't know that.
There's not a single scooter manufacturer out there that are creating commercial grade scooters. Now, what does that mean? That means that you're buying a personal scooter, you put it on the street, and it's going to die. It's going to break down quickly. So you're buying a decreasing asset that's going to break down on you for commercial use, which goes into your overall cost. And it's not a model that can continue, and then you add in theft,
This gets back to what I was saying earlier about the plastic fakeness of Silicon Valley startup culture, which it doesn't have to be in SV to be of that nature, of that fake nature. Now, here is a business which probably got money from your everyone you expect. Its most recent round was with the Abu Dhabi Growth Fund, Fidelity Management, Uber, Highbridge Capital Management. They probably have received, I don't know, I'm just guessing, all of the companies, all of the regular, the regular players in venture capital probably threw money at them. And all of those people got squeezed last year. And they're going, everybody, we have to take a certain percentage of our asset portfolio and flip them SPAC to recover some money.
Well, but look, the people that invested this round, that $523 million, oh, by the way, when they invested $523 million, this company already had a $418 million debt that they haven't paid.
Right.
Okay.
So, by the way, whenever I see Abu Dhabi Growth Fund, companies like Abu Dhabi Growth Fund, and then I forget the main investor in WeWork is a different guy. I forget the name. Masayoshi Son is the CEO of that.
Okay.
Whenever I see those two companies, I go, oh.
Well,
God.
because they're high risk investments in that if it fails entirely, they're willing to write that off anyway because they get that credit anyway.
Right.
Does that make sense? And
Right.
that's the difference between this year and last year. Last year there was a lot smaller amount of those companies, which is why last year's round of funding for them failed. It's because there were people not risking these high risk, I'll just write it off, right? Extra money investments. And this year, so they turn around and they're
SoftBank. Sorry.
Okay,
so
SoftBank.
Right. So when I see SoftBank and any of the Middle Eastern, sovereign wealth funds have invested, I go, oh, okay, you're doomed.
Well, part of that 525. Guess what? So you got $418 million in debts.
Right.
You raised $523 million
in venture debt, which is not regular venture funding.
$105 million of that comes from a bank that that particular bank specializes in loaning money to below investment grade credit ratings, right?
Right.
And oh, by the way, in all of this that Lime released, didn't release the interest rates on any of these loans.
Yeah. So basically, the long and short of why I included this story was, hey, guess what? They're putting out this company that has the exact same logo as LimeWire, the old peer-to-peer sharing network. And what they're effectively trying to do is dump garbage on the market and hope that the consumers bail out the billionaire investors.
Well, they look across the street.
Looks to me.
They look across the street, and you have a competitor, which is the second largest, Bird, went SPAC and raised $2.3 billion, right? So again, by the way, raised $2.3 billion as an SPAC, and the stock dropped 40% in the matter of the week. So your average investor has now taken a 40% loss on their investment because it wasn't a profitable business to begin with, right?
So there was a statistic that I saw in a Wall Street Journal video or someone else that said something along the lines of, there's this rush to do SPACs, but all the SPACs are they perform horribly.
Well, because their initial investors are getting their money back. You're
Correct,
giving rich people their investment money back and taking on that debt as a shareholder and not even understanding it. Right.
And I just, right before we started the show, was telling Big Man that I made huge investments in things that I don't even understand.
But
he's
that's the average person. And then you think about, because most people assume in their head somewhere that if they go to, let's say you're going to buy a car and you go to CarMax, you are there going, okay, CarMax is a name that I recognize. So that in your brain goes, well, that means they're going to take care of me in some way. The car that they're selling me is not going to be a piece of garbage.
No, they're not going to take care of you at all.
But no, they're not. But my point is that because they're a big company, there's a part of you that assumes I can go to CarMax and I can buy a car for a decent price at a decent, you know what I mean? Whatever. That I'm not going to get bamboozled instead of by the meth head down the street that's trying to get me to buy, right? They assume it's different. People do in their brains, right? This is one of those where people go, oh, there's a new SPAC, right? It's a new publicly traded company. So I'm assuming in my head that the market, right? This must be a profitable company if they're going public. This must be a blah, blah, blah so you're assuming this is a real company with a real product that's making real money. And if you don't do enough research, the fact is it's not. And then you lose all your money and you wonder why, when in all, really what you did is you handed your money with a billion other people, your little bit of money, to the initial investors so that they could have their money back. Right. Because if they don't get their money back, they might have to sell one of the yachts in their fleet. Right, exactly. And that why? And if that's the rules, if I can take a non-profitable company
Yes,
and make it a
public.
reverse merger on SPAC and make
Yeah.
it public and get my investment back and all the interest that I'm owed because it's all in the
Yes.
debt, right? It's all
Right.
hidden in the numbers, right? So I can get my 100 million plus my 100 million of debt that I've accrued over the last 3 years of investing in this company. I
Right.
can walk away with $200 million because I've shoved it off on you, and I, give an extra bonus to my yacht captain, right, or
Right.
whatever.
Of course.
So and this is why a lot of people don't even buy and sell stocks. They then in turn give their money to wealth managers that find this information and don't invest in these companies.
Right. Well, that's smart. That's good.
Right. But again, then they get fleeced by those same money managers because they're making,
For
what I mean?
points, and the points are always absurd. But that's
Yeah.
just the way the ball bounces sometimes. I just thought this was funny because it's freaking scooters, and they're trying to take these insane valuations. It's scooters.
Look, folks, at some point when you want to start a business, you start, and look, I'm not telling anybody not to try anything. Try anything
Right.
you want.
Of course, yeah.
Just constantly reevaluate whether it's worth what you're
Exactly.
dumping into it. Right? I mean, that's all. That's all I'm saying. If something
Yeah,
is
that's-
dropping, if you've borrowed $500 million or $418 million that you can't pay back, maybe it's time.
But if it in the scenario where I've invested or borrowed that kind of money, I just want everyone to know here and now, I will take the company public via SPAC. I will collect my money back,
Of course, Danny would.
and I'm not going to say sorry on the back end.
But I'm just saying, at some point, you got to go, hey, maybe this is not a sustainable business model.
Right.
Or maybe it's too early. Maybe it's not the right time.
Right.
Whatever. Okay.
I just don't think that the peer-to-peer economy, unfortunately, the peer-to-peer economy, which we thought, like the likes of Uber and Lyft, created or really popularized is a better
Right.
phrase. I don't believe it worked. And the reason it didn't work was because there was a race to the bottom, because there was too many competitors to be the platform. And once you train a consumer that it's $2 to deliver your groceries, you're not going to be able to explain to that consumer, well, it's $15 to deliver your groceries. And that's if we're delivering 5 to 5 of your neighbors. But we're taking a loss on it so that we can gain market share to push somebody else out. And then when that fails, we're going to take the company public via SPAC so that our investors can recoup their investment. And then we're middle fingers to the sky. You're all going to lose all your money. And that's business though. That's competition.
Well, but commercial rental, rental cars, for example.
Right.
Okay,
Correct.
Enterprise, Avis, all these different. There's a reason you don't see Bob's rental car on the corner anymore.
Right.
Because there came a time that Bob could not own enough vehicles to rent them out to your average consumer and the
Right.
damage that they cause on average and get enough money back for the car payment that he bought the car for, right?
Right.
Enterprise and these fleet vehicles can buy them at a cost that it makes money to make money, right? To make sense.
Right.
Bob's rental car can't do that, right? It became an
Right.
unsustainable model, which is why these big conglomerates came about, right?
Right.
Falls in that same category. You cannot rent commercial goods to your average consumer
Right.
because of the way they take care of things.
Right. Which, listen, there's a joke or meme among car guys. The fastest car is the car that you rented.
Well, but that's my point.
Yeah.
You're relying. If you sat down on a piece of paper and said, "All right, I can buy a
Scooter
Let's
for-
Pro scooter for $1,000." Well, and if I can rent that out at $1 for 1,000 hours, which it should last longer than that, now I've made a profit. Well, that idea makes sense. The
Right.
problem is when you're dealing with the average everyday person that's going to rent a scooter, because
I don't care. I'm breaking
people
it.
that have a net worth of $1 million plus aren't renting a scooter,
Correct.
right? So they're not going to probably treat your $1,000 scooter like a $1,000 scooter. They're going to treat it like the dollar per hour that they're paying.
Right.
And then you combine that with it's not made to do that.
Right.
Right. There's a difference between commercial grade made products
and consumer
made products.
Yeah.
There's just a difference in durability. Right.
Because it's, if you look at, for people, it's easy to understand. If you look at commercial grade flooring versus consumer grade flooring, you ain't even in the ballpark.
It's not even close. And it costs more for that commercial grade flooring, but it lasts them. It's a higher value because it lasts them so much longer. And that's the difference. So I don't blame that for not existing because there's not a market for it to exist.
And they've proved by using consumer grade scooters that you can't make money.
Right. So why would any scooter manufacturer out there make a commercial grade scooter when they know the business? That's what I'm saying. So all the different angles of this, because let me tell you something, folks. If it can make money, people in the world will figure it out.
Somebody will figure out how to make money.
So the fact that this company, right, that there's no manufacturer out there ramping up its commercial grade scooter manufacturing,
right,
is just another red flag to tell you that this is an unsustainable model. Because I guarantee you, if there was a company that thought that there could be money made from renting out scooters, it would be making commercial grade scooters tomorrow. It would figure it out.
Yeah.
Because demand for a product, right, it just comes out. So it's just another red flag to stay as far away from a Lime scooter S-Pack as possible.
Then, correct. Well, today I want to close by giving you our tip of the week. As I do, I end our show every week with the tip of the week. And the tip of the week is, in the United States of America, I want to tell you about the greatest, absolute best deal in all of retail. Across their 2,100 plus locations, you can go to any Aldi store and rent a shopping cart for 25 cents and just take it home with you.
God, you're awful.
It's a quarter. You can effectively buy a shopping cart for a quarter.
It's still stealing, Danny.
It's not stealing. I gave them money. It is the best deal in all of retail, I tell you.
Danny has no idea what a social contract is. And on that note, folks, we'll see you next week.
All right.